So good afternoon, everyone, and welcome to today's Fireside Chat with Crux Climate's CEO and co-founder, Alfred Johnson. I'm James West. I run the Sustainable Technologies and Clean Energy team for Evercore ISI, and today I'm joined with Sarah Bianchi, our Chief Strategist of International Political Affairs and Public Policy. Sarah recently rejoined Evercore after serving as Deputy U.S. Trade Representative from 2001 to 2024 and overseeing critical trading relationships across Asia and Africa. Crux Climate is the ecosystem for developers, tax credit buyers, and financial institutions to transact and manage transferable tax credits. Its network and tools streamline transactions, provide access to large markets, and reduce risk and increase trust. Crux Climate's team brings extensive experience at the highest levels of government, business, energy, technology, and finance. Alfred is the CEO and co-founder. He served in senior leadership roles at the Department of Treasury, working on technology, financial markets, management, and financial regulatory issues. He previously founded and sold a mission-driven SaaS company. He's advised governments and banks at BlackRock and was head of sales and people at a venture-backed fintech company. He graduated from Stanford University with a bachelor's in political science and government and an MBA in general management. So, Alfred, thanks for joining both Sarah and I today.
Thanks for having me again, James. Good to be back.
Yeah, absolutely. Well, when we first spoke last summer, the transferable tax credit market was really in its infancy at that point. Since then it's exploded. Crux is right in the middle. And with your inaugural transferable tax credit market intelligence report recently released, I am looking forward to digging into that and what you found. But first, maybe for some of the newer listeners that may not be as familiar with the company, can you give us a quick explanation of Crux Climate's role in the tax credit market?
For sure. And James, can't talk about Crux without first talking about the Inflation Reduction Act and the clean energy, decarbonization, and advanced manufacturing credits created by it. So the market for those credits opened on January 1st of 2023, really started to accelerate around the time that we talked last time. That was in August. The first deals started to close later that month. And then a lot happened in Q3 and Q4. I know we'll get into that in greater detail, but we found that 7 to 9 billion of total transactions on 2023 credits have happened or are happening, which is much larger than people had anticipated. And then to what we do. So as the Inflation Reduction Act was passed, it became quite clear that there would need to be a deep and liquid market for these credits with software at the center of it. Crux is that platform that is leading in that space. We've now raised about 27 million of venture capital, with 18 million of that coming most recently from Andreessen Horowitz. We've got $8.5 billion worth of credits listed for sale on the platform. We've done deals in bioenergy, solar, storage, advanced manufacturing with public companies in the Fortune 100, smaller companies, private companies, family offices. And in that sense, we are starting to build a really good understanding of the way that these deals come together and how to make them more efficient. Our platform can be used by buyers, sellers, and intermediaries to facilitate these transactions. And again, this is just a market that is one of the largest that has ever been created by the government, that is developing incredibly quickly. And we've got some good data on the way that that's coming together.
That's great. Thanks, Alfred. And I forgot to mention, for all those that are listening in to the webinar, please feel free to insert questions into the Q&A box at any time, and I'll make sure that either Sarah or I get those questions over to Alfred. Alfred, you guys just raised, I think, 18.2 million in a funding round. Could you talk about the significance of that level of funding for the company's mission?
Yeah, so the company was formed about 15 months ago. We raised a seed round pretty quickly on formation that was led by Lower Carbon Capital with participation from QED, some strategics. Then we raised a seed extension pretty shortly after that, brought in Ørsted, LS Power, Hartree, Canopy Ventures. So that brought total funding to 9, which allowed us to go really quickly in the back half of last year. And again, this market, because of the speed that it's developing, the need for infrastructure to facilitate transactions has been really high. So as we started to do deals and it became clear that there's an opportunity to build something quite large and important at the center of this market, we partnered with Andreessen to raise that $18 million Series A. And part of the purpose there, James and Sarah, is the new tax credits are at the center of a quickly growing catalytic force from the IRA to support renewables and decarbonization, but they also change the way that these projects are financed. And as a result of that, there are lots of opportunities and needs to drive capital into projects more efficiently. And we see the transferable credits as a very important, essential first mechanism upon which we Crux can build and make sure that companies that are building critical energy infrastructure are able to access capital as efficiently as possible. So that is part of the reason why we have raised so much so soon and to go as quickly as we have.
Got it. And we have a question that just came in from the line. Who are the largest buyers and sellers of credits in the market right now, from what you guys can see?
Really interesting question. So in order to answer that question, I'm going to do a little bit of brief history. So the tax equity market is a market that has preceded the transferable credit market. And to go back to why that exists. So we in the United States use credits to incentivize energy policy. We've done it for a very long time. We've done it for decades in renewables. And in a certain sense, the use of credits is efficient and has very strong political characteristics to them. They tend to be more durable. They have a pretty fundamental flaw to them, which is that many of the developers that build these projects and get the credits don't pay enough taxes to be able to use them. They previously had to depend on monetizing those credits, of effectively selling those credits via partnerships, where an investor, a tax investor, usually a bank, would participate in the ownership of the asset and receive the tax attributes that are associated with it. That market has grown to roughly a $20 billion market over the last couple decades and has largely been provided, the capital in the market has largely been provided by the largest banks. Now, what the IRA did was massively expand the use of credits. They're made more generous at the project level. They are extended to different kinds of technologies than got them before. They are put in place for 10 years or until we get to 25% of 2022 greenhouse gas emissions levels in many cases. And what that meant was the supply side of the market was dramatically increasing. And with a larger supply, Congress needed to solve the question of how they would be monetized, looked at the tax equity market, and came to the view that there would need to be an alternative mechanism by which they could be monetized. So created this new tool of transferability. And now to the question that's been asked, that has brought in many new participants to the market by necessity and also by design. These are simpler transactions than tax equity, so many more kinds of corporations are able to participate in them. In the early market, we're seeing large companies, small companies, banks, non-banks, all different kinds of structures around this. And that is very encouraging for what the long-term trajectory of this market will look like. And frankly, we need it in order to be able to accommodate the level of supply that is going to come to the market in the next few years and certainly by the back half of this decade.
Alfred, it's obviously a very complicated marketplace with a lot of different stakeholders. Can you talk about some of the partners that you all are working with and why they are so important for this business?
Yeah, so we work with three broad categories of partners. There are sellers of credits, and those could be across 12 different kinds of federal credits. So it includes solar and wind and battery storage developers who are selling their credits. It also includes manufacturers who may be building components that are associated with the energy transition. It includes people that are building carbon capture and storage facilities, and those are sellers in the market. They range in size. We have credits that are currently available for sale for 10 digits, and we have ones that are available for 5 digits. And in that sense, the market is quite distributed. On the buy side of the market, the largest participants will be the Fortune 50, large banks, people that are historical tax equity players, but we're seeing small corporates participate, not just the Fortune 500, but the Russell 3000 and private companies that pay taxes, and in some cases, family offices that have a sufficient amount of passive income. And that means that the market is fragmented on both sides and significantly more fragmented than it was in the tax equity market. And then the third category of partners that we Crux work with are intermediaries. So people that are making markets in these credits, and those could be banks, tax advisors, standalone syndicators, and Crux can be used by those partners in their brand to manage transactions and access supply and demand.
Got it. And we have a question that's come in, Alfred, on why are there some types of credits that are in higher demand? Are there particular components of this market that buyers are looking to solve for?
Super fun question. Okay, so we did this market survey that covered $3.5 billion of transactions. There were three inputs to that. There was Crux platform data, there was survey data that we picked up by asking people about transactions, and there's publicly announced data on the market. And with that, we have been able to paint the clearest picture of pricing and supply and demand dynamics that the market has yet seen. And what it shows is healthy pricing across the board. So we are seeing pricing that is for $10 million credits averaging at about 89 cents per credit, per dollar of credit. For $100 million plus credits, we are seeing pricing closer to 94 or 95 cents. So the first answer to the question would be bigger credits tend to have more demand in this market than smaller credits. But smaller credits are still seeing enough demand to have pretty healthy pricing. And 89 cents, Sarah, is roughly the same price as the price on LIHTC credits in the market today. And that's a 37-year-old market. This is an 8-month-old market. So good indications there. We are seeing buyers differentiate on the perceived risk associated with credits, and ITC, investment tax credits, where there's a determination that has to be made on the fair market value or the CapEx in the project. Those are perceived to have more risk of recapture associated with them. That recapture risk steps down over a 10-year period. It is often, almost always, insured by the seller to the benefit of the buyer, but has headache risk, may carry some risk in being able to recoup any costs that come from that. And so in that sense, ITCs are trading at a discount to production tax credits. Production tax credits are kind of the premium product in the market. They are generally associated with units of energy, components, materials that are produced. And in that sense, they're less controversial from a valuation perspective, right? A unit of energy yields a unit of tax credits, and it's a meter reading. And those kinds of credits, even in new technology types, are seeing appreciation on price versus investment tax credits.
And so if Congress's intent was to try and make this so simple and so that everyone could use it, why do we need intermediaries?
So it's still a new market. It is in many cases, a multi-million-dollar, sometimes $100 million transaction with many underlying documents, hundreds of underlying documents, lots of stakeholders at the table, and buyers that are navigating it for the first time. There were, dozens of tax equity participants, and we're looking at the need for hundreds, if not thousands, of new buyers that need to participate in this market. And buyers, and we assessed this in the survey data that we did, buyers are very focused, understandably, on the risk that's associated with these transactions. They really want to make sure that they understand it, that they are guided through these transactions from people that are following it very closely, that they have the right service providers around the table. And in that sense, intermediaries are playing a really critical role to unlocking the early market and bringing more people into it. And I think given some of the dynamics about who the buyers are, they're, tax directors at companies, they're generally not paid to, prospect on the future tax capacity of the business. Because of some of those dynamics, I think you will always see intermediaries playing a critical role in the market. Now, I do think we're also going to be able to make these transactions more efficient, more routinized, more standardized, and that will accrue to the benefit of efficiency in the market. But this will never be like a couch that you buy on Craigslist, right? Like it's a substantial transaction with substantial underlying information, and necessitates some experts, at least around the table, to advise to make sure that you are buying something that makes sense.
Got it. And maybe could you give us a quick introduction to transferability in the tax credit market? Because that's kind of the key here. And in your view, how is this market, taking shape, as of today? Obviously, it's substantial growth. But how do you see this unfolding?
Yeah, it's funny. Tax credits have been such an important part of energy policy for such a long time, but they've never been made transferable before, even though there has been this problem where the developers, the people that earn the credits, don't have the tax liability to use them. And so transferability is a super necessary evolution. It would not be possible to use tax credits as widely as the IRA does. And the IRA is roughly 2/3 tax credits, largest climate bill ever passed by any government, and tax credits are the largest component of that. Without transferability, you wouldn't be able to make that subsidy effective.
Right.
And now that the subsidy has relied upon the formation of a vibrant market here. And in the early market, we are seeing healthy pricing, more buyers coming to the table. Interestingly, we are seeing that transferability has unlocked tax finance to smaller projects than got it before. Tax equity, by its complication, tends to be something that the large banks won't want to do on credit sizes or tax equity investments of less than $75 or $100 million. And that has meant that if you're a producer of a solar facility or something and your credit amount is sub $50 million, you haven't had very good access to tax finance. One thing we found in our market survey was that 80% of the credits that we tracked were sub $50 million. And what that shows is that transferability has leveled the playing field and allowed for many different types of credits that wouldn't have otherwise been sold via tax equity to be sold via the transfer market. And the same thing applies for new technologies, right? The IRA provided credits to things like standalone battery storage that didn't have it before. And now those types of credits are able to be monetized via the transfer market, which is in some cases, many cases, maybe a more appropriate and effective place for them to be monetized than the tax equity market.
Got it. We've got a bunch of questions that just came in from our listeners here. Maybe I'll start with this one. What is your competition and how many markets are out there right now? And do you see that this will converge into a single market at some point?
So this is such a fast-moving space. It's so fun to be in a market that is as large as this one is, that it's developing as quickly as it is. And, just to put a number that I have said into context for a moment, the $7 to $9 billion of transactions on 2023 credits, that happened between August of last year and now, right? So that's a huge acceleration and amount of transactions that's happening across a lot of different credit types over a short period of time. And we have a ton of growth ahead of us, right? If you believe that this market is going to be anywhere near where people are estimating it will be by the back half of this decade, then we've got 5, 6, 7, 10%, 10x growth in the market over that period. And that means that there are a lot of companies that are looking at it in various forms. The banks are evolving their businesses around it. Tax advisors are working with their corporate clients to navigate the market and purchase credits. There are some other platforms that have stood up around it. We are very focused on software. We are software entrepreneurs. We have done this in the past in a marketplace business. We have raised venture capital in a large amount to go out and be the central software that is used in this market that also accommodates and provides particular priority to the role that intermediaries play within it, in the view that if we can bring intermediaries into the market, we can add their supply and demand and volume into our market also. And nobody else is doing that strategy and investing the level of resources that we are to be the central software player.
Gotcha. And then there's another one. How does the Crux platform address the direct pay eligible credit opportunity, and are there any listed today?
So with direct pay credits, interesting other characteristic of the IRA. So this problem of developers not having the tax capacity to be able to internalize the credits. In some cases, the government, via the law, gave certain categories of credits and types of entities access to what is called elective or direct pay. That means that they can take the credit directly to the IRS and the IRS will pay them the cash value of the credit. That is a feature of 3 categories of credits: 45V, hydrogen, 45X, advanced manufacturing, and 45Q, carbon capture and storage. With each of those categories, those companies can make a 5-year election where they can take elective pay. In many cases, the companies are back-weighted in the production that they will generate into the market, just based on where we are in the production cycle with the development of many of those new technologies. So in many cases, those companies are sellers of credits in the transfer market now, with the future intention to flip into elective pay in the period where they are producing the most of whatever they are producing. There is an interesting dynamic where transferability tends to have better cash dynamics to the seller than elective pay. And that also depends on where you are in the year. And the basic dynamic there is that in transferability, you can sell your credit at any time within the year and get paid for it, albeit at a discount, but you can get that cash. Versus if you're using elective pay, you have to file it on your tax return. The IRS needs to process it. The IRS needs to pay you. So there may be a meaningful difference in the number of months between when you could access cash in the transfer market and you could access cash via elective pay. And that's leading to some pretty interesting characteristics in the early market around some of those credits that can alternatively be sold or provided to the IRS via elective pay. There's another category, which is nonprofits, cities, states, Indian tribes, the Tennessee Valley Authority, basically like nonprofit entities and governments that can take their credits directly to the IRS and be paid for them at the cash value. None of those entities, for the most part, had the value of the tax credits, could realize them before, and now they can via elective pay. There's a very other nuanced issue about people being able to maybe sell their elective pay credits, which is an area that the IRS is seeking comment, but I will spare everybody the details of going deeply into that.
Got it. And then maybe could you talk a bit about, or help us understand, or me understand? I know Sarah gets all this stuff, but the eligible basis, bonus tax credits, and the importance of insurance in tax credit transactions.
Okay, so first on eligible basis. So there are 12 credits that can be sold for cash. They have all different characteristics to them. Broadly speaking, there are investment tax credits that are associated with the CapEx or fair market value, production tax credits that are associated with the units that are produced. With investment tax credits, there is a question of what the value of the project is. And typically, within the tax equity market, you're seeing project basis be established by virtue of a fair market value assessment provided by an appraiser when the project is placed into the partnership at a higher value than the expended capital into the project, because the project is then deemed at that stage of construction to be worth more than the cost basis of it. And those developers are able to take the investment tax credit against the stepped up basis. So project had a cost basis of 100, they stepped up the basis to 150 and take the ITC of 30% or whatever it is against the 150 value as opposed to 100. It's a question that has always been around these deals. It was very relevant in tax equity prior to transferability. There's a question of what is an appropriate amount of step up for developers to take, which is one that the IRS has not given a clear answer on, but the market has sort of converged around 15 to 20% being a relatively safe amount of step up to take. And there's increasing innovation on the capitalization side to help developers to step up the basis via minority investment as opposed to tax equity partnership. But this ends up being a thing that is diligenced by buyers and ends up implicating things like price, and is one of the things that is insured. I'll come to that in a second. On the adders, the way that the law is constructed, they incentivize development in certain areas like energy communities, which could be census tracts where coal mines have been closed, or EPA brownfields. They incentivize development when the people that are getting the power associated with the project are low and moderate income. They incentivize the development via higher credit amounts in an area that Sarah knows a lot about, which is domestic content associated with the project. And in all of those cases, depending on your qualification, you may have a higher credit amount than the base credit amount. And that also tends to be an area that is insured. So quickly to insurance. In areas where there is any sort of interpretation risk or a risk that the IRS may later determine that the fair market value was inaccurate or something like that, you are often seeing insurance procured by the seller to the benefit of the buyer to make sure that they, even though they technically bear the risk associated with recapture, that they are covered by the insurance policy if such a thing were to happen.
So, Alfred, I want to switch topics a tiny bit. Obviously, a very big week this week in terms of the 2024 election. And we have one of the major candidates, Donald Trump, calling for the elimination of this law. And we've seen some votes and some efforts in Republicans in Congress. How do you all think about that? What do you think the risks are? Some credits more vulnerable than others. How should we think about that?
Yeah, so first of all, the credits have been in place for a long time, right? They are extended and expanded by the IRA, but investment and production tax credits have in some cases been around for as long as since the 1970s. They have been extended and expanded by every configuration of government in the presidency, in the House and the Senate over that period. So, they have been a pretty durable piece of public policy within the United States. Obviously, the IRA includes a lot of different components. There are those investment and production tax credits associated with things like wind and solar, but it is also expanded to categories like advanced manufacturing and hydrogen and bioenergy and a bunch of different things. And that means that the amount of credits that are in the system is higher, but it also means that the number of industries that are implicated by it is higher. The number of jobs that are created all across the country is higher. And frankly, and you've seen a lot of this, Sarah, this is just good public policy, right? We're driving investment into local communities to make energy infrastructure more secure and more stable. We are reshoring domestic manufacturing in a pretty significant way. Those jobs and that economic activity is happening all across the country. And one thing we have seen in a lot of cases where that kind of development and investment happens is support follows, right? It relates to the well-being of people in those places, and that makes these kinds of policies harder to take away. And my view is, as people see the positive benefits of the IRA, they already are. The support for it across the political spectrum is going to improve. And frankly, that is borne out by the legislative history of this last Congress. And in some cases, they have tried to put the IRA onto consideration in the House, for example, around the debt limit fights in the summer of last year. And that has pretty quickly fallen off the table, I think in part because people acknowledge, even on the right, that there is a lot of benefit that is flowing into communities across the country, including places like energy communities and coal country, that are benefiting from higher credit amounts than they would have gotten before. And that is really, really beneficial to those communities.
Well, I think just to add a bit to that, first of all, some of the communities, we're seeing them across the country, as you mentioned, and seen many studies that in states with Republican senators, Republican members of Congress, a really heavy presence there, and also potentially in terms of controversy, potentially, I think it's been a bit more borne out on the consumer EV credit and some of the politics and the divisions around whether you should subsidize the buying of that type of credit and some of the other foreign ownership requirements. There's a lot more swirl there. I don't know if you agree with that. I guess I'd ask that. And then also, I would say the one thing that I, would put the production credits, I don't, again, see whether you agree, is that the congressional budget estimators keep revising upward the take-up rate here. And do you see more of a risk as those estimates come up and if there's more deployment than maybe initially thought?
I definitely agree with the former point, which is that the EV credits and some of the consumer credits are more vulnerable and have been more politically polemic. So I think if you're in the situation of Republican unified control, I would assume that some number of those credits will be restricted or removed. I think the GGRF, Greenhouse Gas Reduction Fund, allocations are similarly more at risk in the case of unified Republican control. So I think all of that is true. With the question of budget impacts associated with certain credit amounts and the overall scoring of the IRA, I think it is entirely plausible that in some sort of bargain around the budget that you would see capping of certain credits. It is uncommon that credits are uncapped to the extent that these ones are. Most of these credits are uncapped. And so I think in some future negotiation, could you see people, Congress deciding to cap the advanced manufacturing credit at some amount? Sure, I think you could see that. I think that is much more likely than seeing a repeal, particularly of that credit, which, as we talk about what it actually is, that is credits that are going to manufacturers of solar panels, wind turbines, batteries, electrical inverters. Those tend to be manufacturing facilities. They are distributed across the country. They create a lot of jobs. It reshores manufacturing here in the United States and away from places like China. And that is the sort of thing that tends to be pretty well supported within the voting base of the Republican Party.
And if you were to see, I think that's a really great point on capping, because that is a normal feature of these kind of credits, as you mentioned, and it is unusual that we haven't seen it here. What would that do to, tell me what you're in terms of your forecasting of the sizing of this market, what would that, what kind of dampening effect might that have?
Well, I think it creates more certainty about market size, right? One of the features of this early market has been nobody really knows. The CBO scored the IRA at 370 billion. Private sector estimates came out well in excess of that. When I say that the market will grow to 80 or 100 billion dollars, I'm depending on Credit Suisse's estimates on that. Goldman has higher estimates on that. And so I think if you were to cap the credit amounts, you would know within some error band what they are likely to be in every year, and that allows for better planning and more certainty about market size. I think from our perspective, whether it gets to 50, 70, 80, 120, right? Like this is a huge new market that is accelerating really rapidly. And from my perspective, there's so much room to grow and enable here that it's plausible that the market would be capped in certain places, and there would still be a really significant business to build and change that would happen to renewable energy infrastructure that would still come from the law, but it would just be somewhat more contained.
Do you see do you think there's any more likelihood, and then I'll turn this away from politics, but of any particular sectors where you might see a cap or you might see a reduction, or are they all created equal in this space?
Yeah, I'll give you an example. As James knows well and has often written about, offshore wind has been an area of ongoing discussion in the country. I noticed that the Florida legislature passed an ordinance or a law on offshore wind off the coast of Florida, even though there is no current offshore wind off the coast of Florida. You could imagine that a Republican unified Congress might prefer certain credits to other credits. I could imagine that carbon capture and storage, hydrogen, advanced manufacturing, categories like that would be reasonably durable. I could imagine that things like offshore wind might be harder to protect. And, frankly, that brings me to the public service announcement part of the presentation, which is to the extent that there are people on the phone that own these companies, are invested in them, are participating in the market on the buy side, it's incumbent on all of us to tell the story about why this public policy is making change, creating jobs, improving energy security, reducing dependence on countries like China. I think all of that is a story that is still very much to tell, that the business community can tell with a lot of authority right now, given the amount of investment that's going in.
I think DeSantis getting ahead of things to make sure everybody knows where he stands in Florida. I personally don't think it was going to impact their tourism business, but that's his call. So we have a question for Juan. For a given type of credit, do you have a standardized product at this point to facilitate transfer? Basically trying to suss out, when does this business start to get commoditized where you can trade credits on a screen?
I think that the market will largely not be the kind that can be traded as easily as a share of stock. I don't think it will ever get there. I think there are certain categories of credits like production tax credits that are coming from investment grade companies where there is no controversy about the units of energy produced. I think that kind of credit will become more fungible. It already is. And to that end, we bring standardized forms to every deal that happens on Crux. You can use them or not. We're seeing more and more people use them, in part because there's a belief and a view within the market that getting to standardization will improve outcomes and efficiency for buyers and sellers. And so people are motivated to move in that direction. And I think over time, the commercial forms around transactions will start to look more like something like an ISDA, where there is some number of key commercial terms that are negotiated within the context of a framework document. And I think we'll get there. Now, I think there are some categories of credits, for example, investment tax credits, where there's determination on the fair market value that needs to be underwritten. There's an insurance policy that needs to be wrapped. There's some amount of diligence that will still need to be done. That kind of credit sale, I think, can be made a lot more efficient, and things like standard forms can help get you there. And technology, specifically Crux, can help make the process of originating that transaction a lot more efficient and less painful. But I don't think that category of credits will be fully fungible anytime soon, and maybe ever.
Got it. Okay. And I know we talked about kind of the sizing of the market, but I wanted to directly discuss the report that you guys put out recently. And I know that some of the estimates for the total size, of course, were determined by, or was estimated by, some investment banks I've never heard of, but that I'm not sure they exist. I think you made them up. But could you talk about the outlook for 24, which I think you gave in your report, and then what we should expect in terms of regulatory guidance, price expectations, the increasing relevance of intermediaries, deal sizes, all the kind of key takeaways, if you could, the summary, I guess, executive summary of kind of the report. And then if I could add to that, if you have thoughts on 25 and beyond.
Yeah, so I'll run through a few key takeaways, some of which we've talked about but are worth restating. One, pricing in the market was really healthy, healthier than anticipated, right? The average ITC in our data set was a $20 million credit that sold for 92 cents. The average PTC was a $60 million credit that sold for 94 cents. The LIHTC market is 37 years old and trades at 89 cents, and this market is 8 months old. And so that is very, very encouraging about the vitality and effectiveness of the policy. We are seeing more credits transact sub 50 million than we anticipated, and that is also supportive of the conclusion that transferability levels the playing field for smaller credits than previously had access to tax finance via the tax equity market. And again, that is consistent with the purpose of the statute and public policy here. We are seeing an increasingly robust bid for new technologies that did not previously have credits and were not previously in the tax equity market. And those are things like advanced manufacturing credits, where actually it's a production tax credit just associated with the units of widgets that are produced in these four categories. And we're seeing that buyers are quite interested in those credits. We also saw some pretty significant positive effects from competition. And this resonates, like, we the humans see competition in a lot of different places. And one thing that you find is that if credits can be sold into an open market, if any product can be sold into an open market, there's a benefit that comes from competition of multiple buyers to purchase that good. And we saw that, we see it now in this tax credit market. To give that specific data associated with that, on Crux, there are 37% of credits that got one bid that got multiple bids. So on the credits that got bids, 37% got multiple bids. On the credits that got multiple bids, we saw a 3 to 6 cent improvement on the price on average. So, really supportive to the sell side of an open market here. Now, some of that effect, I think, will start to wear down as the market becomes more efficient. But it is really supportive of the value to there being a central town square where the credits transact. As far as outlooks for 24, the early 24 market has been a bit slower than was anticipated at the end of 23 for one particular reason, which is Congress has been considering this new tax bill that increases the amount of R&D tax credits that corporates are able to take, but that law has not passed. And so there is uncertainty among companies as to whether or not they'll be able to use R&D credits in place of these clean energy credits. And they're generally waiting, or many are waiting, to see the conclusion of that to know their tax liability. And so that has influenced the pace of deal making in the first quarter. I fully anticipate it to catch up as the year goes on. We'll get to some conclusion legislatively there. And I think you'll see the continuation of the trend that we saw in Q3 and Q4 of 23, where there's just a lot of interest in this product versus other versions like tax equity. So I'll pause there. There are other observations I might make on things like new structures that are being applied in and around this credit market. But I think that may be an additional level of nuance, and we'll go there if questions take us there.
We had a question come in from the line. Are the credits that are posted with Crux or intermediated through Crux exclusive, or can the sellers post the same credit on other platforms as well?
It's a mix. So some credits are listed on Crux, but not exclusively. Those sellers may be, for example, proceeding or attempting to sell the credits directly to known buyers while they are also listing the credit for sale. We are increasingly doing exclusive partnerships with sellers to sell on Crux and offering fee discounts to do that. In part because it's just a better experience in all directions. It's a better experience to the buyer. They know that credit is available for sale on the market, will trade on the market. And so I think we will do a lot more of that in 2024 and beyond, just given the benefits.
Got it. And then maybe last one for me, and Sarah may have a few questions as well, but before we wrap it up, but what are as you think about the next 12, 24 months and the evolution of Crux, what are kind of the key milestones that we should be looking for, we should be watching for to know that you're hitting those success levels that you guys have set yourself? Well,
we have the opportunity here, I think, to build a very vibrant and important and effective market for the energy transition. If we do this, if we're able to build a central ecosystem where many different buyers are able to connect with many different sellers across many different credit types, then we're driving a lot of capital into projects that really need to be built, and frankly, into projects that would not have gotten that kind of financing in the absence of a platform like that. And we're doing things like contributing to the efficiency and standardization of the market, not just in legal documentation, but also in process that helps to make these deals more efficient and allows then more buyers to come in on the basis of an easier transaction. We will also do things like invest a bit more in partnerships. We exist within this ecosystem of other service providers, ESG advisors, insurers, lawyers, others like that. And in that sense, we see opportunities to scale those partnerships with all kinds of different companies around Crux. We already are putting those in place. Frankly, we're hiring somebody that will sit over that responsibility because of the level of importance that we assign to it. And, from a business perspective, we will look to do somewhere between $500,000 or $500 million and $1 billion worth of credit sales on the platform. That's GMV that is sold via Crux in 2024. And I think we're on track to do that. And then the last thing, James, I'd point to is we will start to experiment just given the amount of pull that we are feeling from the market with ways in which we can support our partners on the development side in accessing capital more efficiently. We get a lot of requests, for example, from developers who want last mile finance of various kinds, bridge loans against the sale of the credits. We are currently referring that kind of thing out. We'll probably continue to do that, but are looking for ways in which we can drive more capital in via the platform and generate even more value to developers who are listing their credits with us.
Great. I had a couple questions that came in from the line. Just I want to clear these through because, and then Sarah, please do join in here. But someone's interested in the new structures point that you made earlier. What do these new structures address, and is it perhaps a working capital need?
Yes. Okay. So 3 principal new structures, and this is fun. Like back to the point, James, of how this changes the way that the capitalization of these projects happen. So there are 3 things that I would point to. One is what the market is now calling tax equity flips. These are partnership structures, tax equity partnership structures that are put in place. The basis is stepped up, the depreciation is monetized, the partnership internalizes some percentage of the credits and sells the remaining credits out of the structure. And the partner is the first owner of the credits by definition, so can be the seller in the market. We're already seeing quite a lot of that. It's just a good product, right? The developer gets what they want. They get the stepped up basis, they get depreciation monetized, and they sell the credits. The buyer is able to buy a credit that has in some way been underwritten by the tax equity provider who is at risk in the deal. And that means they perceive it to have a lower level of risk associated with that. That's going to be a pretty dominant, I think, structure at the high end of the market. We are also seeing, I mentioned this in passing, minority investments that are made into the project before the project is placed into service, where something like 20 or 25% of the project is purchased by a minority investor at a higher valuation than the cost basis of the project. That facilitates the basis step up. The minority investor is typically getting a preferred return on their investment there. They often have a option to be bought out at some number of years down the road. And then again, the developer is getting a higher credit amount on the higher basis that is achieved via the minority investment. That's another category where there's a lot of innovation and activity happening right now. And then the third has to do with the working capital question, where a lot of developers and producers, manufacturers are looking for ways in which they can pull up the cash that would otherwise be associated with the credit sale and see an opportunity to use the receivable of the credit as a mechanism of getting finance against the project. And we're seeing more and more interest in that kind of product from both sides of the market. And frankly, again, this is one of the reasons why we raised the level of capital that we did. We see the transferable credits as being pretty central to those innovations and see opportunities at least to refer out business and maybe to build other ways in which our partners are able to access capital.
And the last one from the line here, and then I'll turn it to Sarah. We can get you back to your day job here. Recently there was some slowdown in the growth of renewable projects due to just interconnection issues and delays. Are you seeing any negative impact on the tax credit market as a result of that, or is it just kind of all systems continue to go?
The tailwind is so stiff that like any headwind like that doesn't materially change the trajectory, right? Like the volume of credits in the 24 market will be somewhere in the neighborhood of $40 billion. And, if there's somewhat slower interconnection or it's somewhat harder to, source modules or something, then maybe that market will be 37 billion or something. And if those tailwinds or those headwinds abate a little bit, maybe it'll be 42 billion. But, it's not so meaningful that it changes the overwhelming support that the market is getting from these incentives, which are so dramatic here. And Sarah knows more about this than anyone, but I saw a headline this morning about the number of panels that have been imported, solar modules that have been imported in advance of some upcoming changes in policy. And that will influence the availability of panels to build things. So there are just many forces that are moving in many directions, including the political forces and interest rates, which have their own have their own webinars that one could have about them.
No, absolutely, that's right. I think there are a lot of different components driving here, and with Chinese ownership questions and a whole range of other things that are playing into this. One thing I guess I just wanted to pick up on as my last question, Alfred, is it was interesting to me, the R&D tax credit, and that that Congress is considering, and usually does end up passing, and that was intersecting with this market. In terms of the buyers of these credits, are they to what degree are they trying to contribute or solve to some kind of ESG mandate or other kind of clean energy attribute when they think about buying in this market, as compared to just overall the various components that you have to think about when you're solving for tax liability and various credits? Are they seeking this out in that regard, or is it really more of a tax efficiency strategy?
The buyers are distributed on a continuum. At one end of the continuum are buyers that care only about the financial and cash characteristics of the credit. On the other end of the continuum are ones that are in the market because of the sustainability goals that they as a company have. And for example, there are certain companies, tech companies mostly, that have net zero commitments that they are seeking to meet, where the principal way in which they're doing that, or a principal way that they're doing that, is sourcing the RECs, the renewable energy credentials associated with projects, and they use tax equity as a carrot to get those RECs. And those would be at the other end of the spectrum here. And then there are a lot of buyers that are in between, right? Who like the financial characteristics, the effective tax rate, management capabilities, the cash characteristics of buying the credits, but also like the fact that they are investing in projects that increase the energy transition and enhance sustainability. And I think we need all of them, right? Like getting to the level of credit sales that we're going to need to get to in order to accommodate 80 or $100 billion of annual credits that are sold into the market is going to require buyers that are motivated for different reasons, and we should welcome them into the market.
I got it. And then it does look like we have a question coming in. We've had an awesomely engaged audience today, so appreciate that. And the question is whether or not Crux is interested in warehousing credits.
Right now, we are following our partners and helping them to source the kinds of capital that they want and need. We do a lot of referrals in kind of every direction. We refer to insurance companies daily, diligence firms daily, tax advisory firms, and the kind of referrals that we're making to capital providers right now fall in that category. I think if we end up finding that our partners are looking for additional forms of capitalization that can be provided through Crux, either via a marketplace kind of product or via some kind of warehouse facility, I think that is a thing that we will learn over the course of 2024 as the market evolves on this and other things.
Well, Alfred, thanks so much for your time today. Anybody that's listening in that has more questions, feel free to send them to myself or Sarah. We can get them over to Alfred, or you can go to him directly if you'd like. I'm sure he's happy to share his contact details. But Alfred, thanks again for doing this. Good to see you again. We'll see you at our conference in June as well.
I'll be there.
So thanks, and
thanks,
have
James.
a good,
Thanks, Sarah.
good rest of your day.
Thanks, everybody.
Take care.
Bye-bye.